I've long argued that this is going to be made for TV trade deals. These are framework deals. Many said that it was impossible to sign that many deals in such a short period of time. Of course, they lacked imagination and clearly did not watch The Apprentice, because here we are, talking. You've got a clock running down the beginning of reciprocal tariffs. We're getting drip from the White House, Bangladesh, Sri Lanka, Switzerland tariffs. I mean, it's a little bit like a Eurovision song contest when, like they give points out one by one. And that's because ultimately, this isn't, this is not what it was a couple of months ago. A couple of months ago, I think most investors thought that President Trump was looking to massively and dramatically change global trade architecture and perhaps even abrogate it, reshore and onshore most of global manufacturing. And that's clearly not it. I think this is an effort to raise some revenue for the fiscal picture in the U.S. And so you're looking at between, 12 and 17% across the board tariff, which is a significant increase, but it's not the end of the world. And that's why the market has reacted relatively positively for the last month.
Yeah, so I mean, this is the irony, right, Marko? I mean, it's sort of like reality TV or a game show. It is entertaining, or even like the Eurovision Song Contest, if it weren't making a lot of investors so nervous. But, you've been telling folks for a long time, and reiterate your thinking behind this, when you marry geopolitics and also markets, right, and take a look at things, you need to take the long view, strategic view. People who try and trade markets tactically on short-term events, whether, tariffs on Canada, where you are right now, have just gone up to 35 or 25, et cetera, they're usually wrong, or rather they bet the wrong way.
Yeah, so there's a couple of things about that. I mean, first of all, President Trump has a certain negotiating style. It's now become sort of fashionable to refer to it as taco trade. Trump always chickens out. I think that's a very simplistic way to think about it. He doesn't chicken out. He makes deals. Period. End of sentence. That's a fact. Now, you may not like those deals. You can argue that the deals themselves are marginally positive and not really worth all the trouble, but they are deals. And so it's not chickening out. Chickening out would mean like, oh, I'm sorry, I didn't mean to impose tariffs. Let me go back into the White House and sulk. No. The tariffs are coming. They're just not dramatic deals. We're not having like reshoring of all of global manufacturing into America, which would have been ludicrous to begin with. So that's the first issue. And that's why I think a lot of investors are focusing on that and like realizing what the taco trade is. The second thing is that first order effects don't really matter. So what do you want to do with European assets right now? I mean, do you want to sell European assets because they have to pay this 15% import tariff? Well, that would be a mistake because that's a first order effect. Second order effects are always much more relevant. And that means fiscal stimulus, that means structural reforms. That means what are these tariffs going to force policymakers around the world to do? Shrug their shoulders and just be okay with less growth? Or are they going to respond to it with structural reforms like we're seeing here in Canada with the One Canadian Economy Act, which I think is a really brilliant measure, or in Europe where you're seeing fiscal stimulus actually make European assets attractive as a result of this bludgeoning by President Trump, which is ironic, but that's why markets are not easy.
Yeah, and as far as, exposure to the U.S. is concerned, you've been saying for a couple of months now that, probably the better thing to do is whatever assets you have in the U.S. or U.S.-based assets, I mean, it'd probably be a good idea right now to maybe even have them.
I mean, I think it depends. Most investors are already up to their neck in U.S. assets. And I think that what we're seeing right now is a reversal of this extraordinary rally of non-U.S. assets. I mean, the dollar got absolutely crushed this year. You've had a significant outperformance by pretty much everybody against the U.S. That's reversing. It could reverse for another month or two. I think that over the next 5 years, your strategic asset allocation should still heed the message of the market from January, February, and March, which was that U.S. assets will underperform the rest of the world over the next 5 years. But next 3 months, I can see a reversal. Nothing goes in a straight line.
Marko, you said earlier that all of these trade deals might eventually be marginally positive, but possibly not really worth it. In which case, when you're trying to look at what Trump's end game is, and you also alluded to this, and that is, of course, partly to try and bring up manufacturing back home and boost jobs in America. Net, though, when the dust settles, how much of a positive do you think all of this trade and all of this tariff nonsense is going to yield versus potentially the unintended negative consequences?
Well, first of all, I'm of a big belief that tariffs are negative for the domestic industry, actually. Like, the U.S. is not some frontier market that needs, 100% tariffs on cars to help its auto manufacturers, like to create an industry. U.S. is an open economy, and it's already advanced in manufacturing. The more you coddle domestic industries, the more they're going to be disappointments. I mean, this is like parenting. If you coddle your children with like massive subsidies and allowances, they're not going to turn out great. And so we know from history that import substitution, protecting industries with tariffs just doesn't work. You're going to start making cars that nobody in the world wants to buy. So I do think that there's a negative consequence of that. That said, I also do understand President Trump's point that he does need to raise some revenue. It's uncomfortable for him politically to call things tax increases, so we're calling it tariffs. But let's be very clear. President Trump was elected on a populist economic platform, but he's delivering actually austerity because he just delivered a significant consumption tax, which is why the bond market is rallying on the news of tariffs. Like, tariffs are positive for bonds. Bonds are ignoring the inflation thing, as they should. Your previous guest articulated why really well from the inflationary dynamic perspective. And I think that the other issue is that you are raising actual revenue that will contribute to lowering of budget deficits. I mean, my forecast right now is that the one big beautiful bill, if you add this 15, 17% across the board tariff, I mean, it's looking like the deficit is going to be under 6% over the next 10 years, probably even lower given where politics in the U.S. is headed. So I think that's the real intention. The real intention is to just raise some money because the U.S. is not in a great fiscal picture.